Welcome to the debate. Right now, big tech is collectively spending roughly $715 billion on AI infrastructure.
Which is, just to put that in perspective, that is more than the entire gross domestic product of Switzerland.
Right, spent entirely on data centers, cooling systems, and silicon in a single cycle. So the question we have to answer today is, are these companies building the railroads of the future digital economy? Or are we watching, the most expensive capital bonfire in corporate history?
Yeah, it is really the defining question for the technology, media, and telecommunication sector as we sit here in early June 2026. We are trying to diagnose the health of an industry undergoing this massive, highly intensive capital transformation based on the latest industry briefings.
Exactly. And it's not just the sheer dollar amount, right? It is the restructuring of global supply chains and the rapid evolution of business models that are pushing corporate balance sheets to their absolute limits.
They really are.
So to frame our disagreement today, my position is that this aggressive, front-loaded capital deployment into AI infrastructure, sovereign technology, and vertical integration is a necessary and highly defensible land grab. It is, frankly, the only way to establish the monopolies of the next decade.
And I take the exact opposite view. I argue that the extreme capital intensity we are seeing, combined with intensifying geopolitical and regulatory headwinds and completely unproven monetization paths, well, it's creating a massive risk. We're looking at severe balance sheet strain and the potential for massive value destruction across the entire sector.
Okay, let's start by looking at the structural reality of the demand. We mentioned that $715 billion capex cycle. Yes, it's a staggering number, but the demand driving it is real, and right now it's completely inelastic.
Inelastic at the top, maybe.
No, we are seeing definitive proof of this in the supply constraints further down the value chain. Look at Yageo, the massive Taiwanese component manufacturer. Their passive components are returning to full production capacity strictly because of AI hardware demand. Or look at the fact that AMD has officially taken the data center revenue lead from Intel. The hardware layer is completely maxed out because the ecosystem is demanding it.
I mean, I understand the demand side of the hardware equation. That's obvious, but my concern is what happens after the hardware is plugged in. The single most critical risk of the market right now is what we call the monetization gap.
The lag between the spend and the return.
Exactly. It's the lag between when a company spends billions on infrastructure and when it actually figures out how to generate a return on that specific investment. You mentioned the hardware demand, but look at who is actually footing the bill. ByteDance is attempting a massive $70 billion capex pivot toward domestic AI hardware.
Right.
But what is happening on the consumer side? They are facing severe consumer pushback on actually monetizing those AI platforms. Users want the features, sure, but they aren't willing to pay a premium for them.
Hold on, let me make sure I'm following your logic here. You're saying ByteDance is spending $70 billion on the infrastructure, but because the average consumer won't pay like $5 a month for a premium AI chatbot, the whole model falls apart.
Yes, it is a return on invested capital nightmare. And it's happening everywhere, not just in social media. Telecom Argentina is committing $1.3 billion to its 5G rollout, but operators globally are struggling to lift their average revenue per user to actually justify these network investments.
But that's a different sector.
The capital drain is immense regardless of the subsector. It's forcing desperate asset sales just to keep the lights on. And on top of that, regulatory risks are threatening to compress whatever future margins might exist. I mean, Meta is facing serious Digital Services Act complaints in the EU right now. You are celebrating a necessary land grab, but when I look at the balance sheets, I am looking at a financial minefield.
I see the logic, but I think the timeline of your evaluation is just too short. The minefield is only dangerous if you aren't building a heavily armored vehicle, and that is exactly what these hyperscale investments are. They are a necessity to secure capacity in an era where capacity literally equals survival.
That assumes you survive the build-out phase.
Let's look at the scale of what's being built. AirTrunk just made a monumental $30 billion commitment to build 5 gigawatts of data center capacity in India.
Wow.
Yeah, 5 gigawatts is enough to power multiple major cities. Or look at Samsung accelerating its 12-layer HBM4E memory.
Right, the high bandwidth memory.
Exactly. For those not deep in the semiconductor weeds, it is essentially the ultra-fast highway that feeds data into the AI processors. Without it, the world's smartest AI chip just sits there starving for data. Samsung is accelerating that production to capture premium AI margins. These companies aren't spending blindly, they are securing the foundational constraints of the 2030s. If you do not have the power, the cooling, and the memory, you simply do not exist in the next decade.
It is a compelling vision, but let's look at the leverage and the customer concentration risk this creates. AirTrunk building 5 gigawatts in India is a massive bet on a very small handful of key tenants. Meta alone is forecasting up to $145 billion in CapEx. You have infrastructure providers like CoreWeave that are operating highly leveraged models built entirely on the backs of hyperscaler relationships. This creates a systemic, circular risk in the market. If the hyperscalers sneeze, like if consumer demand for AI pauses for even a quarter, these highly leveraged infrastructure providers are going to catch pneumonia.
That's a fair point on leverage. But
We have to ask who is actually capturing the margin here, beyond the pure hardware fabricators like NVIDIA or TSMC. Because right now, infrastructure players are taking on massive debt to build facilities for software companies that frankly haven't figured out how to charge for the product yet.
see, that is exactly the dynamic we saw during the building of the 19th century railroad networks.
You're comparing AI data centers to steam engines?
I am comparing the capital cycles. The upfront capital absorption to lay those steel tracks across the continent was staggering. It bankrupted massive companies, but owning the foundational rails was the only way to capture the exponential economic value that followed for the next 100 years. AI infrastructure is the railroad.
Okay, but
And yes, the pure hardware fabricators are making the immediate margin, just like the companies that forged the steel tracks did. But look at what is happening at the software layer right now. Companies like ServiceNow and Salesforce are engaged in a massive race to build the AI governance layer. They are positioning themselves to be the high-margin toll booths on these new railroads.
toll booths. Right.
By embedding control, security, and agentic governance right into the enterprise workflow, they are locking in recurring revenue that will completely dwarf their initial CapEx hit.
Well, I look at that railroad analogy a bit differently. Those 19th century railroads were built in a world that was actively expanding and integrating. Today, the technology sector is moving in the exact opposite direction. You are talking about building a global network, but the frictionless global market doesn't exist anymore. The immense capital being deployed right now is forcing a localized restructuring of where and how technology is built. We are seeing massive geopolitical supply chain shifts.
You talking about the reshoring efforts?
Exactly. U.S. export controls and trade tariffs are forcing an incredibly inefficient bifurcated world. Intel is shelving its European fabrication plants in Germany and Poland because they have to refocus all their capital on the U.S.
True.
Apple is actively navigating an extended memory crunch because they are trying to pivot production out of China and into India with partners like Tata. Think about what this does to a company's cash flow. The working capital required to domesticate supply chains is completely breaking the cash conversion cycles across the hardware sector. You are paying a massive premium, in cash, upfront, just to move the factory from one country to another. You aren't improving the product, you are just paying a geopolitical tax.
Okay, but that geopolitical friction is exactly what is creating massive protected opportunities for sovereign champions. When the global market fractures, regional monopolies emerge.
Monopolies that are highly inefficient.
Let's look at Huawei. They are actively capitalizing on U.S. export controls to erode NVIDIA's market share in China. Because NVIDIA is restricted, Huawei is projecting a 60% revenue surge this year, hitting $12 billion purely for its AI chips. That is a highly defensible, sovereign moat created by the very geopolitical friction you are warning about.
Yeah, but
We are seeing the exact same dynamic in Europe. Deutsche Telekom's T-Systems is effectively monetizing sovereign GDPR-compliant cloud infrastructure via their new deal with the Shear Group. They took the European Union's incredibly dense regulatory complexity and turned it into a premium product. Sovereign AI isn't just an inefficiency, it is a localized monopoly.
A localized monopoly that demands continuous, state-level capital injections to stay afloat. And this immense pressure on capital, this need to simultaneously fund next-generation AI compute
while completely rebuilding localized supply chains, well, it's trickling down and crushing the foundational layer of the digital economy. I'm talking about the telecoms operators.
Right. The telcos.
They are fighting an existential battle for survival right now. They are being squeezed from above by hyperscalers demanding infinitely more bandwidth, and from below by regulators demanding lower consumer prices.
See, I wouldn't call it an existential battle for survival. I'd argue the telecom sector is going through a forced but necessary evolution.
The data tells a much darker story, though. Look at Digi. They are facing predatory pricing probes in Spain and wholesale access mandates in Romania. Regulators are effectively destroying their infrastructure moat by forcing them to share it. Mobile network operator lease cancellations are directly hurting the tower companies. We just saw Crown Castle execute an $8.5 billion divestiture just to deleverage their balance sheet. Telcos are spending billions just to stand still. Look at AT&T's massive Open RAN rollout.
Let's pause there and clarify Open RAN for a second, because it's a huge shift in the material. Open Radio Access Network basically breaks up the hardware and the software of a cell tower. Historically, if a telco bought an Ericsson antenna, they had to use Ericsson software. Open RAN uncouples them, so telcos aren't locked into a single vendor forever.
Exactly. In theory, it prevents vendor lock-in over a 10-year horizon. But look at the reality of the execution. In the short term, it is pure capital destruction. Where is the return on invested capital in sending a crew out to replace a perfectly functional operating antenna with a new Open RAN antenna simply to change the back-end architecture?
It lowers future CapEx.
You are spending billions of dollars today, destroying your free cash flow, and you aren't offering the consumer a single new feature that they are willing to pay for. It is the monetization gap in its purest form.
You are looking at the short-term capital hit, but missing the long-term structural defense. That Open RAN rollout is a highly sophisticated capital efficiency strategy. The telcos know they can't charge consumers more for a faster pipe, so they are completely restructuring their operating expenses to protect their bottom line.
By spending more money.
To save money permanently, take Virgin Media O2 and Keo data centers. They are locking in 10-year renewable power purchase agreements. In an era of extreme energy price volatility, locking in power costs permanently de-risks a massive portion of their operating expenses. That protects EBITDA. And to address your point about the inability to raise consumer prices, they are shifting aggressively to value-added services. Swisscom isn't just selling internet access anymore. They are embedding Bitdefender cybersecurity directly into their home routers.
Which is just bundling a third-party service.
It's not just bundling, it's about creating switching costs. If your home internet suddenly provides enterprise-grade cybersecurity for all your devices at the router level, you are significantly less likely to switch to a competitor to save $5 a month. They're transitioning from providing a commoditized dumb pipe to providing a secure digital environment. They are protecting their average revenue per user by making it mathematically illogical for the consumer to leave.
Embedding a third-party antivirus software into a router is a tactical band-aid. It might buy them a few quarters of reduced churn, but it is not a structural moat against hyperscalers who are essentially eating the network from the edge inward.
But this strategy, embedding value to prevent churn, it isn't just a telecom strategy. It is the exact same playbook that the software and payments platforms are executing right now to defend their margins. We are seeing a massive drive toward vertical integration and the race for what the industry is calling agentic commerce.
Agentic commerce being the idea that AI agents will handle transactions for us?
Precisely. Think of it this way. A company like Stripe doesn't just want to process the payment when you click buy. They want to power the autonomous AI agent that decides what to buy, negotiates the price, and executes the transaction on your behalf in the background.
Right.
If they own that entire loop, the actual payment processing fee becomes a secondary benefit. They own the ecosystem. That is why Adyen just deployed $876 million to acquire Talon One. They want to move beyond the checkout page and embed promotional logic and loyalty programs directly into the merchant's operational stack.
Yeah.
That's why Shopify is aggressively pursuing money transmitter licenses across the United States. And it's why Stripe is partnering directly with Google to capture this emerging agentic commerce market. They are absorbing capital now to build an impenetrable ecosystem that owns the entire life cycle of a transaction.
And here's exactly where the thesis hits a wall for me. The closer these technology companies get to the actual money flow and the end consumer, the harder the regulators are going to strike. This is the ultimate regulatory trap. You look at Shopify getting money transmitter licenses and you see an expanded moat. I see a massive, permanent compliance cost center that will completely destroy the promised margin expansion. Acting like a bank means you get regulated like a bank.
But they have the scale to manage it.
Scale doesn't grant you immunity from sovereign states protecting their turf. Look at the regulatory enforcement happening across the board right now. The EU foreign subsidies regulation is actively hitting JD.com's European M&A ambitions with C economy. Diddy is facing unresolved airport access disputes in Mexico that directly threaten the revenue models for the 2026 World Cup. Regulators are actively stepping in to protect domestic stability. Look at MasterCard facing systemic threats to its entire network from the sovereign-backed European Payments Initiative. When you vertically integrate into highly regulated spaces like finance and telecommunications, you invite the state directly into your boardroom. The compliance drag on these vertically integrated models is going to severely punish the margins you think they are protecting.
That is a fascinating way to look at it. But let me offer an alternative view on compliance. What if that regulatory friction is actually a barrier to entry that protects the incumbents?
How so?
Think about the mechanics of it. If you are Stripe or Shopify or Adyen, you have the balance sheet to absorb a massive team of compliance lawyers. You have the capital to navigate the EU's Digital Services Act or build GDPR-compliant infrastructure. A disruptive startup operating out of a garage simply can't. Earlier, you mentioned the 14.4 million euro GDPR fine that Amadeus caught in Spain.
Yes, for their data monetization pilot.
Exactly. But 14 million euros? For a company the size of Amadeus, that is not a devastating penalty. That is essentially a very expensive R&D consulting fee to find out exactly where the regulatory boundary is drawn. The compliance costs that you view as a margin-destroying drag are actually cementing the oligopolies. They price out the competition. It's a feature of their moat, not a bug in their business model.
Calling a multi-million-euro regulatory fine a feature is a very creative accounting philosophy. But let's step back and look at the actual cash flow across everything we've discussed today. The structural reality tying all these themes together is that the lag between building this infrastructure and monetizing it is widening.
Okay.
You have a $715 billion AI CapEx cycle. You have the massive working capital drain of relocating supply chains out of China and Taiwan. You have telcos spending billions just to swap out antennas. And you have the escalating compliance costs of tech platforms acting like banks. All of this drains free cash flow. If your balance sheet isn't perfectly structured, if you don't have impeccable treasury architecture to manage cross-border liquidity, you will face a catastrophic liquidity crisis long before your AI agent ever makes its first autonomous purchase.
And I think that brings us to a crucial point of convergence. Whether you lean toward the aggressive growth thesis or the defensive risk thesis, the fundamental differentiator in the TMT sector right now is capital allocation discipline. It is specifically the ability to manage working capital and secure highly efficient financing to survive that exact lag you were talking about.
Absolutely. The winners over the next 5 years will be the management teams utilizing highly sophisticated financial engineering. We are seeing companies issue corporate hybrid bonds, which are part debt, part equity, specifically to raise capital while protecting their senior credit ratings.
Right.
Or look at the massive supply chain finance programs being spun up to keep the hardware vendors afloat. If you are Lenovo and you are trying to hit $100 billion in revenue through the sale of AI PCs, you have to actively finance your component suppliers, or your whole ecosystem grinds to a halt. The treasury function has fundamentally moved from the back office to the absolute forefront of corporate strategy.
We agree on the mechanism of survival. I maintain that the massive capital deployment into AI, sovereign infrastructure, and vertical integration remains a structural imperative based on the briefings we're seeing. These investments, while heavily front-loaded, will forge the definitive market leaders of the 2030s. The scale of the expenditure is unprecedented, but so is the total addressable market for autonomous digital economies.
And I maintain that the path to the 2030s is littered with severe capital destruction. The monetization gap is real. The geopolitical fragmentation of our supply chains is highly inefficient,
And escalating regulatory compliance will severely punish any management team that misallocates capital during this transition. Not everyone will survive the crossing.
Which leaves our listeners, the executives and investors navigating the space, with a highly complex reality. Synthesizing everything we've debated today, we believe there are 4 critical questions decision-makers must be asking their teams right now. First, how long can your balance sheet genuinely sustain the AI CapEx cycle before you hit the monetization gap?
Second, is your supply chain and your working capital structurally resilient against the accelerating geopolitical bifurcation of technology? Or are you just absorbing the costs of market inefficiency?
Third, are your product roadmaps fully pricing in the rising structural compliance costs of data sovereignty and platform regulation?
And finally, do you have the necessary treasury architecture in place to manage the incredibly complex cross-border liquidity demands of this global industry restructuring?
It is clear that simply observing the trends is no longer enough. You have to look at the market through the aggressive growth lens of securing capacity while simultaneously applying a rigorous defensive risk mitigation lens to your capital allocation. The picture is incredibly nuanced, and there is so much more to explore in the ongoing evolution of the technology, media, and telecom sector. We will leave it there for today. Thank you for joining us on The Debate.